Hi learners, welcome back. Professor Joe here. I hope you all are doing great. In today's video, we are going to learn some new concepts about the Forex market. So let us see what is new in this stage or in this video. This video is going to be a bit technical. You need to pay very close attention to understand all these small terms that are used in Forex, but it is very, very, very important. So the first term used is PIP, percentage in point. This is the smallest price movement. So whenever there is a small price movement, we call it, there is a movement of 1 pip, 2 pip, 10 pips. Okay, so that is how we say in the Forex market. In Forex market, you buy a currency using another currency. So normally it is always quoted in currency pairs like Euro USD. For example, in this Euro USD currency pair, we would say that Euro is the base currency and it is quoted using USD. So USD is the quote currency and Euro is the base currency. Why? Because you are giving a price using US dollar. So you're quoting a price using US dollar for 1 euro. Okay, that's why Euro is the base currency and USD is the quote currency in this example. Currently, when I'm recording this session, 1 euro is equal to 1.0872 USD. Okay, so to buy 1 euro, you have to give 1.0872 USD. Now, when we look at the PIP movements, how do we understand or how do we say that there is a price movement that is happening? So, with the same quote that we have taken, Euro USD, where 1 euro equal to 1.0872, we say that if the price moves from 1.0872 USD to 1.0873 USD, we say that the price has moved up by 1 pip. And if the price goes from 1.0872 to 1.0882, then we say that the price has moved up by 10 pips. And if the price moves from 1.0872 to 1.0972, then we say that the price has moved up by 100 pips. And on the other side, if the price moves from 1.0872 to 1.0871, we say that the price has moved down by 1 pip. And if the price has gone down from if the price has gone down from 1.0872 to 1.0862, that means the price has gone down by 10 pips. And if the price has gone down from 1.0872 to 1.0772, we say that the price has gone down by 100 pips. So this is how you understand the price movement in pips. Normally, whenever there is a currency pair shown, after the decimal point, there is always 4 digits shown. Okay, but there are some brokers who might show 5 digits also. So if the broker is showing 5 digits, the 5th digit is called the pipette. Normally, it is always 4 digits. And with JPY pairs, you will always see that after the decimal, there are only 2 digits. Okay, over here you can see 1 USD equal to 145.40 JPY. Now you can see over here in this pair, USD is the base currency and JPY is the quote currency. In the earlier example, Euro was the base currency and USD was the quote currency. So it's very important to understand which is the base currency. The first currency is the base currency and the second currency is the quote currency. After the pips, the second important thing that every trader should know is what are the different size of lots available to purchase in a Forex market. So in a Forex market, every time you purchase a currency, you have to purchase it in lots. So there are 4 options available. The first one is a standard lot. In a standard lot, there are 1 lakh units. In a mini lot, there is 10,000 units. In a micro lot, there is 1,000 units. And in a nano lot, there is 100 units. Okay, so second important aspect is the lots. You must know with how much lots you are purchasing the currency. Because if you enter a wrong size of the lot, your entire account might get wiped out. So it's very important that you fix the right lot size before entering the market. So let us see what is the amount required to enter into different lots. So if 1 euro is equal to 1 USD, which is not practically possible, it can happen, but not very, very practical at this current stage. So just for understanding purposes, we are using that example. So to buy 1 lakh units, you need to have $1 lakh with you. To buy 10,000 units of euro, you need to have $10,000 with you. To buy 1,000 units of euro, you need to have $1,000. And to buy 100 units, you need to have $100 with you. Because we have taken the example that 1 equal to 1. 1 euro equal to $1. Right? So let us see in the real world. Okay. If 1 euro equal to $1.0872, then what is the amount that you require? And if the money required is so huge, then how do traders enter into the forex market? So let us see that also. So first let us understand what's the leverage, and then we will understand the price. So first let us see what is the leverage. Now every broker and every liquidity provider will give you leverage. It can be 1 is to 50, 1 is to 100, 1 is to 200, 1 is to 400, and 1 is to 1000. Leverage is good, but if you don't know how to use it, it can be very, very dangerous. But first, let us understand the advantage of having leverage. So in the same example, if you go to buy a standard lot, that is 1 lakh units, you need $1 lakh. But because you have a leverage of 100 times, you divide that 1 lakh with 100. Then all you need is $1,000 to buy one standard lot. Same way, you need only $100 to buy a mini lot. You need only $10 to buy a micro lot, and you need only $1 to buy a nano lot. Earlier, what you needed $1 lakh, $10,000, $1,000, and $100. Now, because of the leverage, all you need is a margin of $1,000 for a standard lot, $100 for a mini lot, $10 for a micro lot, and $1 for a nano. So if you want to buy one standard lot of euro, that is 1 lakh euros, all you need to have is $1,087.20. Now over here, there is no spread. There is no ask price, no bid price. We have directly calculated. But if the brokers and the liquidity providers have to earn some money, they have given you a leverage, no? So they need to earn some money. So how do they earn the money? They earn the money by making sure that there is an ask price and a bid price. So when you go to buy a euro, a standard lot of euro from a broker or a dealer using Forex, they will not sell it to you at $1,087.20. They will sell it to you at a higher price. So let us see what is that higher price. And when you go to sell it back to them, they will buy it from you at a lower price. So let us see what is that lower price. So that is called the ask price and the bid price. So if you go to buy one standard lot using US dollars, the broker will charge you $1,095.20. It is higher than $1,087.20. Why? Because that is the spread that the broker is adding for their profit. This is called the ask price. And when you go back to sell that same lot of euro back to the broker, they will only pay you $1,080.20. Now, this is just an example that I'm taking. Okay. So here they are charging you $7 for one standard lot while buying and while selling. So the gap is $14. The gap between the ask price and the bid price is $14. This $14 is called as the spread. Higher the spread, higher the money that the brokers are earning, the liquidity providers are earning. But there are a lot of disadvantages if the spread is too high. There has to be a spread, because if there is no spread, how is the brokers and the liquidity providers going to earn money? So there has to be a spread. But if it is too high, it is not good. So let us look at the disadvantages if the spread is too high. So if the spread is too high, your trading cost is high, because every time you buy and sell, you're paying more. It reduces your profit. Scalping becomes difficult, because scalping is quick entry, quick exit. But every time you're entering and exiting, you're paying more brokerage or you're paying more spread. Then you will not be able to make good profits in scalping. Difficult to enter during news time because of the spread. If the spread is high, you want to enter at an X amount, but the market is moving very, very quickly up and down, very volatile. Then you are thinking that you will enter the market at X price, but by the time you enter, you are entering at Y price. Either it is higher or lower than what you were expecting. It's because of the spread. So with higher spread, entering during news time also becomes difficult. Normally, good brokers will not have high spreads. So brokers with high spreads are normally the people who manipulate the market, which is not good. There are two types of spread, fixed spread and floating spread. Traders normally prefer the fixed spread because they know every time they enter and exit the market, what amount they are going to be. But traders who do not trade every time or the news, they only trade when the markets are very, very slow. For them, floating spread is okay, because when the markets are slow, the spread will not be very, very high. Then they can enter. But normally traders prefer fixed spread because they do not have to think at what time they are entering into the market. Now the advantage and disadvantage of using the leverage. Let us take an example of a standard lot. Say example, you have $1,000 in your account. Because of the leverage you have got from your broker, you buy one standard lot. Because you can buy one standard lot for $1,000, so you buy it. If the pips go up by 1, you will earn $10. If the market go up by 10 pips, then you will earn $100. And the market go up by 100 pips, you will earn $1,000. That means you double your account with just 1% movement in the market, which is very, very common in Euro USD. 1% movement is a common thing. Twice a week it happens. But just imagine, what if the opposite happens? You entered a buy trade and the market goes in the opposite direction. 1 pip down, you lose $10. 10 pips down, you lose $100. And 100 pips down, that is 1%, you lose your entire account, minus $1,000. So when you're using the leverage, you have to understand with what lot size you are entering, whether you want to enter with the standard lot, whether you want to enter with a mini lot, whether you want to enter with a micro lot or a nano lot. My suggestion is, when you enter initially, enter with a nano lot or a micro lot, because for a new trader, it is more important to survive the market. Take small losses, because if you survive the market, you will remain in the market to make big profits. I have written a book on the same concept, which I will display at the end. In summary, what we have covered in this video: understanding of pips, its movement, what is the different types of lots available in the forex market, what is the margin required to enter a trade, what are the advantages and disadvantages of leverage, what is the ask price and the bid price and the spread, and finally, how to use leverage. If it goes in your favor, it's a great advantage, but if it does not go in your favor, it's a big, big, big disadvantage. You should understand pips, the lot size, the leverage, the spread, all these things we should understand, and then only use the leverage to the maximum. As I already said earlier, I have written a book especially for new traders. Traders, you can win, but first learn to lose. The concept is, take small losses so that you survive in the market. And once you survive the market, you will learn to make profits. All I can say is keep learning, keep growing. Thank you very much. Namaskar.